and you need
This program is brought to you by the Kentucky Small Business Development Center in Louisville. We provide the professional expertise, tools, and information necessary to help you make sound business decisions. Thank you to the U.S. Small Business Administration for co-sponsoring our program and to our host organization, the University of Kentucky. Contact us at 502-625-0123 to get started.
Hey, welcome everybody. I'm Dave Etkin. I am the director here at the Louisville Small Business Development Center. And as always, I'm joined here with Janet, who is our communications director, my good friend and co-worker. So today, hey Janet.
Good afternoon.
Yeah. So we got a lot going on today. And as always, just to make sure that everything's working, because we tend to run into a problem here and there. If you look at the bottom of your screen, you'll see a toolbar bar. And if you don't, just take your cursor down there and it'll pop up, and then you'll see the chat feature. And if you would just click on the chat button and just type in hello and tell us where you're joining from, and just to make sure that you can see and hear me well. So just we'll take just a second to let everybody join. And if you would just type in your name, say hello, and tell us where you're joining from. It's always kind of fun seeing where everybody joins from. Sometimes we get people from some pretty interesting places, which I like. Walton, Kentucky, there's Jim. And so Walton, Kentucky, interesting. Kenny and Bill from Louisville. Alan, hey, Kern's Kitchen. Yeah, I'm sure you had a great week last week with the Derby and your great Derby pies. Southern Indiana, Marcia. Allison from Lexington. Yeah, we got a ton of people popping in today. Good to see everybody. O&M, Kentucky. All right, hello. Yeah, tons of people today. Hey, Meg from Northern Kentucky, I guess Covington area. Yeah, we were just up there over the weekend. So good to see everybody, and thanks for joining us this Tuesday for another Toolkit Tuesday. As always, if you have any questions or comments, just put them in the chat there, and I'll keep an eye on it. And so will Janet. We'll pop in and answer some questions. So, and at the end of our session today, as we exit, a survey will pop up. If you guys wouldn't mind, it'd be very helpful for us if you wouldn't take that survey and let us know what you think. Give us some tips and some suggestions for the future. That's really helpful. We really appreciate when you do that for us. So also just a reminder, we'll later on today or maybe tomorrow, we're a little busy today, we'll send you these slides, and we will also give you a recording of this presentation. I hope you find it helpful, because I found it very helpful. And today is going to be, more of a kind of a rough numbers day. So if you are one of those people that are, scared of numbers and a little math challenge, we're going to make it as easy as possible, but, buckle in, because it'll be a bunch of numbers today. So I'm going to go ahead and jump on and share my screen, and we're just going to get going here. How are we looking, Janet?
Looks good.
All right, excellent. All right, there we go. So what are we going to do today? So, understanding your break even is probably the most important thing that you can do to really move your business forward. I mean, it is something that I benefited from greatly. I was lucky enough to have a mentor early on that showed me this, and it's made all the difference in the world for me. So today we're going to talk about, we have to kind of set the groundwork. So we're going to look at understanding the difference between certain expenses in your business, understanding the difference between fixed and variable expenses. We're going to look at and try to understand how to calculate a contribution margin. This is a little bit different than what you normally would see on a gross profit calculation on your P&L. And then with those numbers, we'll calculate a break even. And then the fun really begins here, because then we can use this number, these tools that I'm going to show you. We're going to use these things to run some scenarios, make some decisions. And like I said, this is where it really begins. This is really, you can really start to use this tool and gain some benefit from it. So let's go. Again, I'm Dave Etkin. Here's my contact information. I'm always so happy to hear from you guys. It's really fun to talk to people. We get people on these webinars from all over the country, sometimes the world, and it's really fun for me and rewarding to learn from everybody and engage with people wherever they are and see if we can help each other out and drive our businesses forward. So there's my email, my phone number. I'm happy to take a text or a call anytime. I'm usually in bed by 11, so don't call me after that. So what is a break even? In accounting, the accounting term is break even is when the point where expenses equal the revenue. There's no profit or loss. It's just an even keel. And we can use these numbers to determine the level of sales needed to break a profit. And you may, this is something you might want to do if you're going to start a business. You need to figure out what those sales level is before you go forward. And last, I just want to say, though, like if you talk to a CPA, sometimes they call this, instead of a break even, they call it a CVP analysis, which stands for cost volume profit analysis. But usually they don't, but I just had this recently pop up, and I thought it'd be interesting and a little bit important to let you know that, just in case your CPA brings this up, you'll know what they're talking about. So we are going to do a break even in 3 simple steps. The first thing we do is we look at our expenses, and then based on how these expenses behave, we classify them in 2 different ways. We use those 2 different expenses to calculate our revenue break-even point to cover that. And then lastly, we can use scenarios to make better business decisions using what we just did. And there's some terms that you need to know as we go through this exercise today. So picture in your mind your profit and loss statement. At the very top, you'll have your total revenue for the period. Underneath that is what you'll see as cost of goods sold, especially, you'll see that primarily when you're selling a product, but there could be some cost of goods sold in different ways. If you have a labor intensive business too, there's another way to classify that. But for the most part, you need to buy things before you can sell them. You need to buy inventory before you can sell them. That is your cost of goods sold. If we subtract from our total revenue, our cost of goods sold, we get what's called gross profit. That's the money that's left over from all the things that we had to buy first before we can sell them. That's gross profit, is the dollars we use to pay all our other expenses, and hopefully there's a little bit left over with profit. Now, we can add some things to that gross profit to make it more relevant to our calculation. And we'll look at that in just a second, but that's called a contribution margin. So contribution margin is these additional expenses added to the gross profit. And this is just a different way to categorize things. And then finally, we look at all our other expenses, and we look at how they behave. We look at them, whether they vary or that they're fixed. So let's dive into this just a little bit. So variable costs are costs that are incurred making a sale, and they rise and fall according to the sales of your business. So here's some great examples of cost of goods sold. We just talked about that a little bit. Cost of goods sold are the inventory items that we bring in, in order to sell. Cost of goods sold also as inventory items. Let's say you're assembling things or making something. So it could be, various things you put together. You can also add on other things that change with sales. So if I have salespeople that are solely on commission, so every time they make a sale, I have to give them a percentage of that sale. That's a variable cost, isn't it? So we could add that in our variable cost stack. Sometimes, packaging. So every time I sell something, I know that it's going to cost me a few dollars to put it in a box and put some packing material in there. I can calculate that. So I know that if my sales goes up, I have to ship more things. I'll need more packaging. I can calculate dollar for dollar what that would be. If you are, let's say you own a franchise, there's always a royalty involved, which means that you pay a percentage to the franchisor, percentage of your sales. So we know what that is. We can calculate that because it rises and falls with sales. So we include that in our variable cost percentage. Merchant fees, your credit card fees, we know what that is. That rises and falls with sales. We can add that in there. And sometimes, especially in maybe manufacturing or some service businesses, you can include labor in that because it rises and falls with sales. So we can use a percentage for that. All the other costs are fixed costs. Those are the ones that stay fixed regardless of whether we have sales or not. So whether we, have $100,000 in sales or 0 sales, the rent is always going to be the rent. It won't change. So these things that, we can list down these things. So rent, insurance, salaries, some advertising, our debt service, these are fixed costs that we can calculate in it. So the first step that we want to do is look at our whole expense, chart of accounts, and then categorize the ones out of how they behave. Now, one thing that I want to say is when we do this to make decisions. We're not doing it to satisfy a tax obligation. We're not doing taxes. We just want to be fairly directionally correct. We don't have to be exactly to the penny correct. This is just a tool for us to make decisions with. So some people argue with me about their utilities. Well, Dave, they say, in the summer we like it cool in here, so we really jack up the AC, so our utility costs go up. And in the wintertime, we're pretty cold-minded and, our utilities are really low. So it varies from month to month. Well, yes, but that's not really, that's really not that important. So, you could, some of these expenses like utilities, you could just do an average total for the year and just use that as a fixed cost. That makes more sense to me because those are all internal preferences. They're not driven by sales, even though they do change. So that's the key there. So here's where we'll dig into some numbers. So we want to look at a few formulas to know. So what do we need to do to get some of these numbers? So what's our variable cost percentage or cost of goods sold? So we just take our variable cost and we divide it by sales, and that gives us the percentage. So that's how we calculate variable cost percentage. Our contribution margin is 100% of sales less all the variable cost percentage. So it's 100% minus whatever percentage equals another percentage. And so the simple formula to calculate a break even is our fixed costs, all those things that don't change, we just add up for a month or a year or whatever, and then we divide it by the contribution margin percentage. So what we're doing is we're taking a dollar, a number, and we're dividing it by a percentage, and that gives us another dollar number out the back end. So dollars divided by percentage equals other dollars. That's kind of how it works out. So here's a great example. So our business has sales of $500,000, $500,000. Out of that, it has fixed costs of $250,000. So all our rent, all those expenses are fixed. And then it has variable costs of $100,000. So that means if we look at our P&L for this business, it'll say $500,000 at the top, less $100,000 in cost of goods sold, equals $400,000 gross profit, minus the 250 of fixed costs and equals whatever profit that is. So we want to know what the break-even point is. So we take the $100,000 variable cost and divide it by our total sales. That gives us a 20%. So that means our variable costs are 20% of the total. We take 100% of our sales minus the 20%. That means 80% is our contribution margin. So if you think about these percentages as a dollar, so our contribution margin, so that just says for every dollar we sell, it costs me 20 cents. Out of that, I get to keep 80 cents to pay all my other expenses. Does that make sense? And so that to calculate our break-even point, we just take our fixed costs, which we know is 250,000. We divide it by 80%. That means our break-even sales for this period needs to be $312,000. Does that make sense? So it can be a little counterintuitive, but that's how it's done. So I know everyone has seen this, and when I first started messing around with this, this is what was presented to me as a break even. You calculate things, and you put it on this chart, and when I look at this, it doesn't really tell me anything. I need a tool that I can use to make decisions with. I don't need something like this that who knows what it's really telling me. So so there's some other things we can do. Let's take a look at this, some other things how we can dig into this and calculate a few other things, give you some examples. So when you look at your business, you'll understand how to do some things. And, when we're talking about sort of a technical issue like this, I'm throwing a lot at you, and I know when we're done here, you'll think about, what did he say? I'm not quite sure. So what I'm going to do is show you some examples of how we calculate things. And bear in mind that I'm gonna talk mainly as this business that we'll kind of play with is a restaurant, because I think most people understand how restaurants work. We order in food, we put it all together, we make it, we sell it. That's pretty simple, pretty easy. So we'll go with that. So what we need to do is figure out what our variable cost percentage is for the things we sell. So in our restaurant example, let's just say we're going to cost out our club sandwich, for example. So what I would need to do is to figure out what the variable cost percentage or our cost of goods sold for this one particular item is as part of our calculation when we start to work on our break-even. How do I do that? I actually have to drill down into all the different parts of our end product that we're selling. So maybe you have a part that you sell to GE as part of their manufacturing, and you have 3 or 4 or 5 parts, and you put them all together, and then you sell it to GE. That's no different than assembling a sandwich. So in our club sandwich here, our ingredients are 4 ounces of ham, 4 ounces of turkey, 1 ounce of shredded lettuce, and 1 hoagie bun. So for example, I know that what I would do is I would, the ham, when I buy it, it costs me $3.99, and I divide that by the pounds, $3.99 a pound. So that means it costs a certain, amount each, almost a dollar for a pound for 4 ounces. And so that's, so the ham that goes on this turkey club cost me $1. I do the same thing with the with the turkey, and then the shredded lettuce. I would, I'm buying a pound of it, I can calculate how much each ounce cost me in weighs, and just add all this together. So this tells me that when I put together this turkey club, it cost me $3.56 to put it together. Now I'm going to sell that for $7.99. So on one sale, I'll sell it for $7.99. That one sale cost me $3.56. I get to keep $4.43 as my gross profit to use to pay all my expenses. So what do we need to figure out turn these all into percentages. So what I would do is just take the 356, which is our cost of goods sold, what it cost me. I divide it by what I'm going to sell it for, and that equals 0.45 or 45%. So if I think about the dollars example again, the 100%. So for every dollar I sell, 45 cents goes to cover the ingredients, and I keep the balance. I keep the 55 cents. Does that make sense? Now, you can do this for one item and it makes sense, but often you have several different things. So in our restaurant, we have sandwiches, and we always keep it at 45% cost of goods sold, but we also have some sides and some beverages. So these things have different cost of goods sold once we price it. How do we figure out what our global, our blended cost of goods sold is? Well, this is another way to do this. We call it a weighted average variable cost percentage. So we've gone through and we've done, we've calculated what our cost of goods sold is for sandwiches. We've done the same thing for our sides, and we know our beverages. So when we look at our sales mix, and for every dollar we sell, 80% of those sales is for sandwiches, 10% is for sides, and 10% is for beverages. That equals 100% of sales. So we can just multiply across. That gives us an average, a weighted average, and this means globally our cost of goods sold is 40%. So that's a number we can use to calculate our break even. Is it totally exact? Is it totally perfect for taxes? Is it to the penny? No, but it's what we need to, it's enough for us to make good decisions with as we move forward. Hopefully this is all making sense to you. So it can be a little daunting at times, but bear with me. The fun is yet to begin. So we can also, what we need to do next, after we've drilled into our cost of goods sold, we have that figured out, we want to put together a contribution margin, which is some other variable costs we can add to that cost of goods sold. So what we've just done is we've taken our sales, our 100% sales, we've figured our cost of goods sold, that gives us 45%, and says our gross profit is 55%. We can add more to that to make better decisions with. So to our contribution margin, we can add some other things. So we'll start with our 100%. Remember, we always do that. We subtract out our cost of goods sold. In this example, we can add labor, perhaps that's 20%. And then maybe we have shipping, which would be 2%. That gives us a contribution margin of 33%. So that means some of these expenses, we take off the expense line and below and move it up into this contribution margin calculation. It gives us a better way to calculate our break even. So now we know these things, we can do some things, and we'll go through some scenarios here, and then we'll show you a spreadsheet that I used, and I'll give to you where you can really have some fun with and make some good decisions. So we can calculate, we can calculate the sales needed to, hit a specific profit target. Let's just say I want my business to always make 15% profit. What would that be based on my business model, my expense thing? So all I have to do is take my fixed costs and I add that to a target profit. And then I divide that by my contribution margin. That will give me what that would be. If I'm thinking I need to hire somebody, when you hire a new employee and they're on salary, your expenses suddenly go up, but that doesn't mean your sales go up right away. So how high do they need to go to cover that new employee? How much sales do this new employee need to generate for you or give you this much benefit, to make it worth your while? So how do we do that? We take our fixed costs, which we know, we add the new salary and divide it by our contribution margin, and that would give us our new sales figure. We can also calculate a margin of safety, so if we have actual sales or if we want to hit a budget even, we can subtract out our break-even sales and divide it by our budget or actual sales. That gives us the percentage of safety between break-even before we drop into non-profitable area. And then this last thing is so much fun because this is just a number you can keep in your head. And as you're out and about and trying to make decisions, you can just whip out your phone and calculate whether this is a good decision or not based on this one little number. It's a spectacular. And basically, the magic number is $1 divided by your contribution margin. So whatever you want to add in there, whatever the increased costs are, you divide that by your magic number, and it'll tell you what the new sales need to be. So here's a good example of a magic number. So here's our example we used before. We had sales of 500,000, our fixed cost is 250, and a variable cost of 100. So that means our contribution margin is 80%. We want to add somebody new, $50,000. So we take our 80% divided by a dollar. That gives us 1.25 or $1.25. That's our magic number. So what additional sales do I need? I just take $1.25 and divide it by the 50,000. That's 62.5 that we need to hit. So right off the bat, you think, I'm going to add $50,000 salary to this guy. I need to increase my sales by $50,000. That's not so. That's not true. Because if you remember, we have cost of goods sold. That means we don't get to keep all the dollar sales. We only get to keep 80%, 80% of those sales. We have to pay 20% first. So that's what brings this into the mix. Now, let's talk about some scenario planning. So we quickly laid the groundwork. I know it's kind of confusing. I threw a lot at you, but what will make it easy is what I'm going to show you now. And that is a spreadsheet where you just kind of plug in some numbers, and it is super easy to use. And I'm going to stop sharing for just a second. And I think that okay. Okay. Got it, Janet?
Yes.
Okay. So here is a spreadsheet that I'm going to show you, and I'll share with you guys later. But this is where, instead of trying to figure out all this stuff on your own, all you need to do is plug these numbers in here, and it'll calculate everything for you. And so what I want to do here in the next few minutes is quickly set up a scenario here, and then we'll use it to make some decisions with, just show you how easy it is. So based on the calculations we looked at, we'll just plug in some of the percentages that we figured out before. So in our restaurant, we know because of what we've done with our, food costs, we figured out what our turkey club was. We said it was 45% cost of goods sold. I'm going to plug that in there. So we are running a fast food restaurant, and we use a lot of paper and to-go items. And we factor that in, so we know that's 4%. We can budget our hourly labor, and this is pretty common practice in the fast food industries, where if you're super busy, you bring in more staff, and maybe not so busy, maybe you don't bring in so many staff. So you can use a variable percentage. So we need to keep that around 20%, let's say, and we have a franchise, and that's 8%. And actually, let's change this a little bit. This should be more like 30. And let's say, let's just leave that alone for now. So that means that we add all our variable costs add up to 62%. Over here, we just plug in our monthly fixed costs. So let's just say we have a bookkeeper that looks at our stuff for $300. We have 350 in insurance. We have towels and mats that are 75 a month. Our LG&E is 850. We have a manager that makes 2,000 a month, and we budget this. Oops, that's way too much. And then the pest control guy comes $490 a month. We have rent of 3,000. Phone 340. We have a loan payment of 2,500. And 75 on trash. Okay. So what we've just set up is that our variable costs are 62%, and our monthly fixed costs are 9,600. So if you remember what we just talked about, we turn everything into percentage. So our 100% of sales less our total variable costs means 62% subtracted out of the 100. That means we have 38% left over to, to pay all our other fixed costs. So for every dollar we sell, 62 cents goes to variable and 38 cents goes to cover our 9,600. So what does that tell us? So if we go down here, we take our annual fixed cost, which is 12 times 96, that's 115,000 a year, divided by our 38%. That means our break-even sales are $303,000. And that means we have to hit that number before the first dollar goes to profit. That's our break-even. It's a big number, so we can break it down even further. We can divide that by 12. That means $25,000 a month, $5,800 a week, or $843 a day. And here's the beauty of this. So, at the it's a Tuesday, it's the end of the day, everybody's all the customers are gone, we're cleaning up, and run my register tape and get the total for the day. And it says $750 in sales. Well, at that moment, I don't need to look at my P&L. I know that I did not make money that day because my daily break even is 843. So that gives me the opportunity to quickly make decisions, without waiting for information, at the end of the month from a bookkeeper and anything like that. So I can quickly make decisions on promotions or other things I can do to really drive sales up. But I wouldn't have been able to make that decision until, I got information down the road. But so this is why this break-even number is so important and valuable to have, especially on a daily basis. So hopefully you saw how easy this was. I just set this up and it tells me right off the bat. So what I can do here is I can use this to make decisions. And I've set this up on this next tab here. I just added another column. So, for example, here's where we had food costs before. And what if we, find a new vendor or change our menu, or we raise our prices, and now our food costs went from 30% down to 27%. That changes everything, doesn't it? What if I want to budget a couple of little things in there? What if I want to always make an 8% profit? I can put that in there as well. I can budget an 8% or 15%, whatever it is. That changes, our total variable costs. Same thing over here on our scenario, on our fixed costs. We can also make decisions with our fixed costs. So let's just say that we have an initial restaurant, it's doing pretty well. We want to open up a second location. It's in a different area of town. But instead of the rent being $3,500 like it is here, it's now $10,000 here, which means our costs went up. That changes everything, doesn't it? But if we can still think we can hit our break even, then we can do that. We can also budget for profit here as well. We can say, instead of a percentage profit, we want to have a fixed monthly profit. We can budget that in, and then we can use this to make our decisions with. So, we calculate our contribution margin as always. And then here's our scenario one, our column one. We have break-even sales of 315 in our scenario. We've almost doubled our sales we have to hit based on the assumptions we make at $570,000. So that can be a lot. Oops, I lost some formulas there. Dang on it. Okay, I'll fix that for us, send it to you. I've also included here on this last tab some of the calculators that you can quickly use to make some decisions with. So let's just say based on the assumptions I put in this other tab, I want to make, in addition to my salary, I want to make $35,000 profit. So that means I have to have $395,000 in sales to do that. If I need to add a new employee based on what we just put in there, and they're going to get $75,000, that means I have to have sales of $500,000. So you can do this with the margin of safety, and then calculate the magic number based on this other scenario. That's $2.63. So I'm going to stop sharing now. Hopefully, there we go. And if you can't wait, and let me pop this back up here. Share here. What you can do is just take your phone and hover over this QR code, and you can download that spreadsheet right away. And I think you'll find it very helpful. So Jason, yes, here is a copy of the Excel template right there. You can send me an email, I'll send it to you, or you can just hover over this QR code on your phone and have it there and download it. So either way. Let's see, what else we got out there, Janet? Any other questions that we need to, hope everybody found this valuable. It's a lot to be thrown at you, and this is probably a full day of exercises and stuff that we're trying to jam in here in about 30 minutes. So
Yeah, no other questions. Maybe just give folks a moment to take advantage of the QR code and submit any questions you might have. I'm going to go ahead and put your email in here.
okay.
We can then follow up with anything that you need. Oh, sorry. Submit to the.
So Alan asked about advertising as a fixed cost. So you can do it either way. The main thing is think about the budget. You don't want to throw money at advertising. Like, first, I'll just say this: you don't want to throw money at advertising without figuring out what works. But once you figure out what works, and that you can calculate, with pretty certainty that if I spend $1 in advertising, I'll get $1.50 or $2 or $10 back. Well, then you've kind of generated a money machine in a way. So you can budget it two ways. You can budget an advertising as ad costs are heavier. So for those of you who don't know, Alan makes Derby pies, and at Kern's Kitchen, they're world famous, and right around Derby, people start eating Derby pies like crazy. And so he ramps things up. And so his ad costs, as he says in the chat here, that are super heavier, just basically for 3 months. So, you could do it two ways. So you can do a percentage of sales. So you could look at your past, advertising spend, see what was spent or what worked well, what percentage of revenue that is. And then you can put that in your variable cost. So throughout the year, you're basically budgeting forward so much of every dollar you bring in that you can budget towards advertising. Or you can use it as a fixed cost. So let's just say throughout the year, we spend $50,000 on advertising. Well, I can budget that, each month, based on that fixed cost percentage. And I can, if I'm not advertising much in certain points of the year, I can just bank that up and get ready for the big push down the road. So those are two ways to budget advertising. There's no right way, just what works best for you. Hey Maisie, how are you? Good to see you showed up there. So Maisie says, if you have wholesale and direct to consumer products, the margins on products is different. Should I create two percentages, one for direct to consumer and one for wholesale? Yes, because those costs of goods sold will be different. So it's just back to the restaurant example. So the food cost on the sandwich is different than the side. So you would calculate those two. You can do a blended, like we went through, we can do a blended cost of goods sold that would be a global one that you can use to calculate break even with. But yeah, those cost of goods sold, those variable costs, and the contribution margins would be different for those things. Yeah. Any other questions? And hi, Joan. Saw you the other day. Good to see you on the line here today. Let's see. Did I miss anything, Janet?
No, I think that's it for today.
Okay. All right. Well, stop sharing here. So I hope everybody got a little bit something out of this. I know it's tough. Let's see. Oh, Jason popped up here. Jason says, how do you evaluate special order costs? In other words, these would be costs incurred outside your normal operations. For example, a farm contracted to produce 100 apples. A prospective client is requesting an RFP on 50 oranges. How will you evaluate contribution margin without certainty on price and variable costs? Well, I think there's always a way, even if it's a special order item, you know what those costs are going to be. I think that you could do that. Again, if it's special, it will have its own cost of goods sold and maybe its own variable cost. And again, you can use that exercise where you blend, different revenue generating lines with different costs of goods sold into, a global contribution margin percentage. I hope that answers your question, but again, we're not doing taxes here. We're just trying to, make some decisions. So I wouldn't focus super much on the details. If you can get directionally correct on the contribution margin, I think that's the most important thing. But yeah, special order costs, and also special orders, since they are special, hopefully you can charge a premium for that, and your cost of goods sold will be lower than your normal items. Hope that answers your questions. That'd be a good topic to banter around for about 30-40 minutes, I think, too. What else? Is that anything? What else we got, Jenna? Anything out there?
No, I don't see anything else, Dave.
Okay.
I remind everybody that we have the survey at the end here. You'll fill that out for us.
Yes, that is very helpful for us, and we really appreciate you taking a couple minutes to do that for us. It really helps us a lot out. Well, if there's no other questions, I really appreciate you guys stepping in and spending some time with me today. And Janet, thank you as always.
Good to see you, Dave.
Okay. All right. So thanks for joining, and we'll see you again on another Toolkit Tuesday. Enjoy your Tuesday and see you next time. Bye-bye.